Okay, it looks like attendee numbers have stabilized. So, welcome again to the Ocean and Air Freight Tracker Outlook webinar for Q1 2026 from TI. Today, we have a very challenging task with all the events going on and the security situation in the Middle East to try and give you as clear a view as we can as to how we think these events are likely to affect the global market, their impact on air and ocean freight rates in the shorter and medium term. So we are publishing our air freight tracker today, which we have had time to include our analysis and insights on. So that report should be with you now, but it will be sent out to all attendees and registrants for this webinar at the end of the session as well, for more detail on our thoughts on the fast-moving situation we're operating in. And we also published our ocean freight tracker actually last Thursday, so just before this all began. And I'm afraid much of the analysis in that report was rendered invalid or moot almost immediately after publication. So that report gives obviously a good view as to what was going on in up to the point of publication, but we will be looking to publish an update to that report next week, I think, in order to give you a clearer view as to how the overall situation's evolved. But we'll wait until we have a clearer picture in order to do that and focus on the webinar and the air freight report today. So we'll be obviously talking a lot about the trends that were going into this quarter today, but we're going to try and focus as much as we can on how we think that these events will reshape the outlook for the year ahead. Obviously, particularly thinking about any cargo transiting through hubs in the Gulf, both air and ocean, and on the Asia to Europe routes, but of course the knock-on effects for the global market in terms of capacity, shipping costs, and so on and so forth. We'll have to consider all of those. So the presentation will last 30 minutes or so as usual, and then we'll have an opportunity to ask any questions, and I expect there'll be quite a few questions today. So we'll try and answer as many of those as we can at the end. We're also going to be running our usual polls for your expectations for rate development in both air and ocean freight, and we'll be taking you through the results of the polls we run on a week-by-week and month-by-month basis as well before then. But I think that will also be very interesting to see how your thoughts have changed on how the market's starting to look later this year. So I'll move on to introduce our panelists. So I am Michael Clover. I'm your host today. I'm TI's Head of Commercial Development. And for those of you who don't know TI, we are a provider of strategic intelligence for the logistics industry. So we cover the developments in the air and ocean, but also warehousing and road freight markets, with this particular use case around freight rates and the outlook and forecast of those. But we also provide more strategic intelligence across the whole global supply chain on procurement trends and supply chain trends more broadly. So we're here to help with any queries you may have about any of that. I'm also joined by our research manager, Vicky Kekarowska, who is instrumental in the analysis for these reports. Welcome, Vicky.
Thanks, Michael.
And as well as Vicky, I'm joined by Janan Hassan, who's one of our data analysts here and is behind a lot of the numbers and the data that we'll be analysing here today. So welcome, Janan.
Thank you, Michael.
All right. We'll move on then to our first content section. And as always, we'll start with the ocean freight market. So here we have our overall global ocean freight rate index, which shows development up to the end of January in this case. So, Vicky, if you could just take us through the trend we're seeing coming into this quarter, and then, difficult task, but try and share some thoughts about how the events of the last week or so are likely to change that picture. And obviously, we'll discuss that more when we come to the outlook section as well.
Yes. So yeah, what's happened to ocean freight rates in this quarter? In early January, we saw a brief increase as the ocean carriers pushed through rate increases ahead of the Lunar New Year. And so that produced some a brief uptick, but on key trade lanes. But then this was followed by a steady softening through February. So this was the expected post-holiday downturn as factories in China shut down and demand stayed muted overall. And TI's index reflects these developments. So in January, rates jumped by 18% compared to December. And if we zoom into the major lanes, the pattern was weaker US market and relatively firmer Europe. So overall, the rate movements we saw in the first 2 months were quite expected because Q1 is usually softer compared to the peak season in Q4. So this quarter was no exception. But right at the start of March, as we know, the renewed Middle East conflict risk is adding fresh volatility to rates, and this is mainly due to war risk insurance changes, the rerouting that takes place, and surcharges. We heard of several ocean carriers already imposing war risk surcharges. So for now, the impact is expected to be lane specific and most acute for Middle East linked lanes. But depending on how long the conflict lasts, we might see ripple effects across other lanes as well.
Mm. Yes, very interesting to consider, isn't it? We have obviously have sort of different cycles as well on the effects. So we have the immediate crisis management for cargo in transit through the Gulf or being rerouted around the Gulf. So we had the challenge there with air freight, for instance, and the flight paths and how to manage that. And in ocean freight, we of course have the immediate crisis of freight trapped within the Gulf or not able to reach destination ports and having to be redirected in the short term. So we have that sort of short order effect, but then we also have the sort of medium order consequences as well, where we can look at obviously ocean freight rerouting. And a talk at the start of this year, and in preparation of Ocean Freight webinar and tracker was, of course, all about maybe potential reopening of the Red Sea. That might ease capacity pressure, have rates probably likely to further fall later this year. And now, of course, we've got to be thinking about that structural shift that we saw last year, really around the Cape of Good Hope is certainly here to stay, and therefore the market conditions that brings about in terms of capacity and transit times and so on. I like to stay there as well. So, a question for us really is going to be all about how long the short-term effects are likely to last, and then when those medium-term sort of countermeasures come in ocean freight, and then in air when we come on to that. But obviously, that's structurally more challenging with many of those air hubs in the Middle East. So lots to think about with that. But thank you, Vicky, for helping us to explore that so far. The next slide is really on demand and volumes, and obviously, again, hard to predict how these are likely to change. The key thing will be moving the volumes that need to be moved, really. But what are your thoughts on volume development, Vicky?
Yes, well, at the start of the year, the volumes were softer compared to last year, but as we mentioned, the story has shifted again in early March because the conflict is distorting the quarter, not so much by destroying demand globally, obviously, but by affecting schedules, by delaying arrivals and tying up capacity and equipment. So first, the baseline volume trend before the latest disruption. Volumes, as I said, started the year softer and importantly, softer than many expected for the usual pre-Lunar New Year ramp that usually takes place. But the big theme was normalization after the 2025's tariff-driven front loading, because we remember 2025 was the year when shippers pulled cargo forward to get ahead of the tariff changes. And that makes year-on-year comparisons difficult. And on a year-on-year basis, the US is a clear example of this softness in volumes. Container imports into the US in January were almost 7% down year on year. And this can be, again, interpreted as a normalization of demand rather than a sudden fall off in demand. And now we have the conflict and the March developments, and they are affecting volumes indirectly. So now, because the Strait of Hormuz is effectively shut, and carriers are taking extraordinary measures, it leads to delays and it leads to volume displacement. So not so much lost volume, but volume displacement. And this displacement of volumes may take weeks to stabilize. It may take months potentially, depending on how long the conflict lasts.
Yeah, very interesting, Vicky. So, I mean, big picture wise, we have to remember that obviously the structural trade shifts we saw last year and then the sort of consequence of those feeding out this year are still very present in the market, even with the current events. And maybe the softer volumes this year is going to be still a major characteristic. But at the moment, it's hard to see past all of that disruption and the short term consequences of that as well. But thanks for shedding some good light on that. So that's the demand pictures as we see it. But looking on the supply side, we have capacity as well to consider, and obviously we'd expect that to be acutely affected by the current disruption crisis. But Jinan, how do you see capacity developing?
Um, so since we put this report together, the market has moved and it's moved fast, and some of what we were tracking just a couple weeks ago has already been overtaken by
Mm,
current events. Um, when we wrote this report, the headline on the ocean side was slight overcapacity. There was too much vessel space chasing not enough cargo, and that was keeping rates relatively in check. And that was the world a couple of weeks ago. That's not the world we're in today. About 3,200 ships, or 4% of global ship tonnage, are idle in the Gulf, although that includes about 1,230 that likely operate only within the Gulf. About 750 ships are backed up due to the strait's closure, and 100 of which are container vessels, according to the CEO of Ocean Network Express. Overall, this means that 10% of the global container fleet is being impacted by the closure in some way or another.
mm,
Um, Maersk, Hapag-Lloyd, and COSCO have all suspended services through Hormuz and are diverting vessels away from the region. Maersk has also specially cautioned customers about possible service disruptions across the UAE, Oman, and Qatar. Um, and thus, not just vessels being rerouted. Two oil tankers were attacked over the weekend, and DP World, which operates the port of Jebel Ali in Dubai, one of the busiest container ports in the world, has suspended operations after an aerial interception cost of fire there on Saturday night. So you've got disruption at sea and disruption in port happening simultaneously. When we wrote this report, there was some cautious signs that Red Sea sailings might be resuming, as Michael mentioned. A few carriers had actually restarted Red Sea routes, and there was a bit of optimism in the market that maybe the worst of this disruption was behind us. Although those hopes were dashed as quick as they came. Yemen rebels have threatened to resume strikes, and in response, the carriers that had restarted the Red Sea sailings have turned their vessels back around the Cape of Good Hope. And as we've seen in the past, this route adds time and costs comparing to just going through the Suez. So we're back to square one on that front, and frankly, possibly worse.
mm. Thanks, Jinan. Yes, it is interesting to think about that dynamic as well between the extent of the vessel stuck in the Gulf and what portion are containers. Container ships we're primarily interested in with the analysis for this report versus tankers and bulk as well. So it's really interesting to get some numbers on that. Um, all right, so a bit of a turnaround then on the capacity story for this year. Um, Obviously, another area massively affected very directly by the current crisis is fuel prices as well. And again, obviously, massive changes since we put the graphs for this together on fuel. But could you give us a sense of the latest developments and expectations for bunker fuel, Janan?
Of course. So since the Strait is this one of the most single important choke points in global shipping, something like 20 to 30% of the world's oil passes through it. And when that gets disrupted, the effects spread fast. Obviously, longer voyages burn more fuel, possibly pushing operating costs up. Um, Oil prices overall, as a result of this, are projected to rise. $100 a barrel is quite possible, taking bunker fuel costs up with them. And back in mid-December 2025, bunker fuel prices were at a recent low, globally sitting at about 402 per megaton. And Europe and the Middle East were actually the cheapest regions to get bunker fuel. And by the 23rd of February, just before the escalation of the conflict, prices had already crept up. And then the war onsets on the 2nd of March, and prices have jumped to 509 per megaton uh, globally in a single week. And that's a week-on-week increase of nearly 9%. The region that really stands out here is Asia Pacific with a 12.3% in bunker fuel prices. And that's not surprising since 84% of oil that passes through Hormuz goes straight to Asia, with China being the key market.
Mm. Yes. Okay, Janan. So yes, we're seeing those prices rising. I guess the big question, widely discussed, I think, is just about how long this is going to go on for, and oil prices, obviously, with the supplies that are on hand, you each have 60 days. As we get down close towards that 45-day supply mark, that's when the prices traditionally tend to move violently or very dramatically. So it would be really interesting to see, will this be resolved before that really begins to bite? At the moment, it does not look like it, sadly. So I think we have to expect that bigger price rise to come in. All right, so now we'll turn really to the outlook section of our webinar today, and that starts really with this sentiment index. So this is where we'd like to invite you to take part in our ocean freights poll and to answer question you should see popping up on your screen now as to how do you think ocean freight rates will change in the next quarter. And we're really interested to see your thoughts on that. And while you're answering that, and before I invite Vicky to comment, I'll just take you through what the results of our monthly sentiments or industry sentiment in terms of pricing survey were beforehand. So basically, on the ocean freight side, we were looking in the Q1 for January anyway. About half the respondents expected rates to rise over the next quarter on Asia to Europe, which was interesting. But we also had a slight increase in actually the people that expected no change to take place at 19.6% last time out. We're expecting no change on that route. On the Trans-Pacific lane, we had a pretty even split, really, of 45.2% expecting an increase and 43% expecting a decrease. So sentiment was sort of mixed, really, for rates, but expecting a relatively flat picture, really. But now, of course, we would probably expect that to change. So now you've completed your poll responses, I'll just end the poll and I'll share the results with you. Well, Vicky, that's quite a dramatic change there, isn't it? 65% saying increasing significantly, 30% saying they'll increase slightly, just 5% saying they'll remain stable. So what's your thoughts on those results, Vicky?
It's quite expected, right? We just heard from Janan about oil prices going up. So in general, the operational costs for carriers are going up, and they will pass through those increases to customers. Yeah, they have already started imposing surcharges. Insurance premiums are also going up. So it is quite expected that ocean freight rates will also increase significantly.
Yeah, so no real surprises in your poll responses there, but good to see where current thoughts are. All right. Now, here is our outlook from the Ocean Freight Report. As I say, I think we'll be publishing an update to this in the coming weeks as the situation becomes clearer for the longer term. Obviously, we were looking at a slight decrease in Q1 and then rates to pick up again towards the end of the year here. But I think we can probably consider ourselves to be in a completely new situation now with respect to the outlook. So I think I'll just ask Vicky, first of all, to pick up on some of the key sort of demand side factors that you see influencing rate development this year and how you think these changes feed into the overall picture for rate expectations as well.
Yes. So going into March, the market was already in a softening trend in terms of demand and rates. But now, as you say, the short-term outlook is dominated by the Middle East or war and the knock-on impact it will have on rates. So even before the conflict began, carriers signaled slower growth. For instance, Maersk anticipated container volume growth of 2 to 4% in 2026, so lower than last year. And consumer confidence, which we know is a very important demand signal, started to improve at the start of the year, both in Europe and the US. But the Middle East crisis could have a very significant macro impact on growth and on inflation. And if this happens, it will feed through consumer confidence and obviously consumer spending. And then in terms of inventories, again, a very important indicator of demand, they are generally lean. So if consumer confidence stabilizes, there is some room for restocking. But again, the conflict may keep the inventory strategies quite conservative and uneven depending on the sector. So yeah, as I said, all in all, Q1 and Q2 volumes down, but we may see temporary spikes later on as the rolled cargo gets cleared.
Mm. All right, thank you, Vicky. Yes, very interesting. And Janan, I fear you have the even more difficult task of trying to talk through how some of these supply side disruptions are likely to affect rates, apart from just to say that clearly they're likely to push rates up in the short term. But what are your thoughts on the supply side?
Um, so with all vessel movements through the Strait suspended, this is already affecting sailing patterns and, like you said, pushing rates up on the short term. Um, the thing is, we've moved very quickly from a market which was dealing with slight overcapacity to a market dealing with real disruption. With the Strait blocked and the Red Sea diversion back and forth, Middle East ports are under pressure, and that can create a knock-on effect on shipping capacity globally. The expectation is that we're entering a period of tightening, and the trajectory really depends on how long this disruption runs. These vessels would normally be cycling efficiently through Middle Eastern ports, and the straits are now sitting idle or being rerouted on significantly longer journeys. So the picture is quite unclear, and it's closely tied to how this conflict will unfold.
Mm.
And on the bunker fuel side, as you mentioned, the amount of time that this goes on will dictate the extent of upward pressure that bunker fuel prices are going to face in the next couple of quarters. Like I said, the longer voyages are burning significantly more fuel at the moment when bunker prices are already trending upwards from before any of this started and have jumped a further 9% since the war's onset. A 9% jump in a volatility sense can be absorbed, but a 9% jump on top of an already upwards trending fuel price is maybe more difficult to deal with.
Yeah, absolutely. Okay, thanks, Janan. And yeah, of course, as we've mentioned as well, we have the surcharges and and insurance costs to factor in as well. So we are expecting those substantial increases, but we'll have to watch closely to see how long those things are likely to remain in place. All right, we'll now turn over to the air freight side of the market, and again, huge disruption. Obviously, we're seeing here with the air transit hubs in the UAE and Saudi Arabia in particular affected, and routes east-west routes from Europe to Asia very badly affected by various conflicts, not just in the Middle East now, but obviously also the ongoing conflicts in Russia and limiting options, or Ukraine rather, limiting options. So we're going to look first, though, at the demand side, sorry, the overall rate picture, and Vicky's just going to try to explain what we were seeing, and again, how these things are likely to feed into the new picture as well.
Yeah, so at the start of this quarter, the rates followed a pretty classical seasonal pattern. So we saw a sharp drop in January following peak season. Then we saw a small mini rebound in early February ahead of Lunar New Year. And then just now a new shock in early March, driven by the airspace disruption in the Middle East. And so in the first couple of months, it was mainly seasonality and timing effects that were driving the rate movements, because Lunar New Year came much later this year, mid-February, compared to late January last year. And this, as I said earlier, affects January year-on-year comparisons and shifts the pre-Lunar New Year peak. And then another thing that affected rates was the weakening in low-value cross-border e-commerce flows out of China, because that's typically a major air cargo demand engine. So yeah, all in all, the story in Q1 is rates are down quarter on quarter, but also year on year, but with some lane-specific strength. And just now we're dealing with a conflict-driven volatility that can push rates up quite quickly, quite suddenly, especially where capacity and routings are disrupted.
Okay, thank you, Vicky. And then on the volume side, you talked a little bit about that, but what's the latest there?
Yeah, so here I think the key story is that we're seeing a clear divergence by trade lane. For instance, Asia Pacific to Europe was growing more strongly year on year than Asia Pacific to the US. And the main reason here was the demand mix. So as I said, cross-border e-commerce out of China is starting to cool down on the US trade lane as shippers adjusted to changes in the US de minimis rules. And this obviously reduces some of the small parcel but high frequency volume that has been supporting air freight into the US. And now we're dealing with the Middle East disruption. And in the immediate term, volumes into the Gulf, out of the Gulf, and especially transiting the Gulf will drop sharply because flights are suspended and routings are being reworked. So the next phase will be redistribution. So the traffic won't disappear. It needs to get rerouted through alternative hubs to alternative gateways, and which will obviously affect where volumes show up and will probably create some short-term congestion.
Thank you, Vicky. Yes, see how that all works through. And obviously, like you say, one big consideration we have for the outlook as well is around the EU changes in de minimis this summer as well. So we have to have a look at that when we get to the outlook section. But we'll turn to capacity now. And again, I'll invite Janan to talk us through how capacity was developing, what the picture was for this year, and then to try and comment on how we think the latest events will change this, if you can, Janan.
Oh, thank you, Michael. I want to give you the before and after picture here because the contrast is stark. Heading into Q1 2026, air freight was actually looking cautiously better than it had for a while. Passenger belly capacity was recovering as airlines rebuilt their schedule post-pandemic and also post-2025 demand slump. There was selective freighter deployment and things were loosening up a bit. DHL estimated that global air cargo capacity was up around 2% year on year in December, and then in January that accelerated to 5% year on year growth. DHL has also flagged that airlines are pulling back from the Trans-Pacific lane and concentrating their capacity on Asia to Europe and Asia to Middle East routes, which, given what happened this weekend, is now a real complication. Two of the world's largest cargo airlines, Emirates and Qatar, are based there. And when that region gets disrupted, the air cargo market feels it everywhere. uh, Airlines were suspending flights, rerouting traffic around the conflict zone, and they couldn't use their key transload hubs in Dubai, Abu Dhabi, and Doha because of the Iranian missile attacks. Emirates alone suspended all operations to and from Dubai until the afternoon of the 2nd of March. And that's not just passenger seats, that's all cargo moving on those rotations gone. Data from Rotate shows that global air cargo capacity is already down 18% compared to last week, and that is a massive drop in a very short window of time. And the main cause is flight disruptions and suspensions by Middle East carriers, and combined with other carriers choosing not to operate into that region.
Mm. Thanks, Janan. Yes, and I think we've already had some questions on, modal shift. Will companies choose to move from air to ocean if those flows are really disrupted? Also, questions on the ocean freight side: is there some sort of land, ocean, land, air, ocean combination that can be used to go around the Gulf? So we'll try and answer some of those as we come to the end as well. But the capacity situation is very, very interesting, and also the fuel again. So we talked about bunker fuel, but what's the situation with aviation fuel, Janan?
Um, Even before this weekend, jet fuel was already trending upwards. IATA's latest composite shows that uh, jet fuel around $95.95 per barrel for the week ending the 20th of February, and that was up 2.2% week on week. Then the weekend happened, and Reuters reported oil jumping by roughly 10% up to around $80 a barrel following military action. And now analysts are warning that prices could push towards $100 a barrel, and that would obviously take jet fuel up with it. Airlines that are still flying are dealing with longer routes, which means more fuel burned, and which translates into less cargo per flight due to weight limits. And some airlines are having to add refueling stops, which does add time and cost.
Okay, thanks, Janan. All right, so we'll move on to the air freight sentiment index now, and I will launch our poll for air freight as well. So while you're answering that, I'll just talk you through the trend we saw in the latest data for the air freight poll as well. So we'll start with the Asia to Europe lane. We did have just over half, 56.7%, expecting an increase in the next 3 months or so. So there was an expectation for an increase coming in there, though it had been coming down, as you can see from the sort of yellow greeny line on the chart there. So that's where we were at before the last week or so. And on Trans-Pacific, again, some increases were expected, about 58.9%. We're expecting an increase there. Again, that was certainly coming down, but still quite a high degree of expectation for an increase there. So the general mood in air freight was that we'd be seeing some moderate increases over the course of this year. But let's see how your thoughts have changed and look at our poll results now. So maybe not quite as well, actually, similarly as strong, actually on the air freight side, with 62% increase significantly, 30%, 31% increase slightly. So similar picture, Vicky, really to the ocean freight expectations for rates. What are your thoughts on that?
Yeah, it's very similar, but I think we should highlight that it's not just the latest conflict and disruptions that are likely to push air freight rates up. Other things that were going on before, for instance, the limited capacity, especially on certain trade lanes. So there are lots of factors here at play that we're going to push rates up anyway in the air freight sector.
Mm.
Yeah.
Okay, yes. So we'll move on to our actual outlook, and I suppose the natural question that follows on from this is obviously this published after today, so after the events, and you can see that our overall rate expectation at the bottom line there is for rates to increase significantly. But I guess a question to kick us off with, Vicky, would be how much has this changed since this was first put together last week? As you say, there was the expectation for rates to increase anyway. So has that just compounded that picture? What's the story there?
Yeah, well, I think one significant factor to consider here are inventories, because they were expected to provide some rate support even before the conflict because they are quite lean, especially in the US. So that means lean inventories. They will support some urgent replenishment when sales go up, or when ocean reliability gets worse. But it all depends now on consumer confidence, right? So if consumer confidence weakens, it means that shippers will rely less on air for replenishment. So that will put downward pressure on rates. So all in all, I think for the rest of this quarter, we should expect significantly higher volatility than the January and February pattern suggested. Some lane-specific hikes, especially in Asia to Europe lanes. And then even in early Q2, I think we should expect some upward movement, especially if there is still rolled cargo that needs to be cleared and schedules are still being rebuilt, even if underlying demand hasn't surged. So, and that's when we are likely to see some backlog premiums in the spot market. They will be short, but sharp.
Okay, thanks, Vicky. And what would you pick up on the supply side, Janan, for sort of key factors over the next few quarters?
Um, so we came into Q1 with improving capacity, but the war has knocked off 18% of capacity in a week. Hubs
Mm.
are closed, belly hold capacity has been wiped, and fuel costs are rising sharply. Capacity will definitely have a strong upwards pressure on rates in the short to medium term, even more so considering that there may be a modal shift that pushes utilized cargo ton kilometers up, as Michael mentioned. As I mentioned earlier, the freight that goes into the hold of passenger planes accounts for 55% of all international cargo capacity globally, more than half. So when passenger flights stop, you don't just lose the seats, you lose a huge proportion of the world's air freight
Mm.
carrying capacity. And in the Gulf specifically, where belly capacity is the backbone of the system, this effect is even more acute. And then there
Mm.
is the indirect effect when aircraft get redeployed and routes get extended or capacity is pulled out of one region, it tightens supply globally. And that includes the lanes that have nothing to do with West Asia. Trans-Pacific is already feeling some of this through capacity redeployment. Uh, on fuel front specifically, fuel accounts for a third of total airline operating costs, and this kind of rise puts upward pressure on rates, and adjustments can happen with very little notice in fuel surcharges.
Mm. Yeah, so I mean that generally brings us on to one of the key considerations or concerns really around for shippers anyway, is that what sort of contractual agreements they have in place are going to be suspended with force majeures coming in, and to what extent are those legitimate, and how are rates likely or prices paid actually likely to change as a response to or a result of all that. So very difficult time to manage your expectations around budgets and service levels as well, particularly. Okay, so that brings us to the end of the presentation part of our session today. Obviously lots and lots to discuss there, but still plenty more questions to ask. So please feel free to use the Q&A tool um, on Zoom here to ask any questions that you have. We have a few already, so we can start off with those. And maybe we'll have one for you first, Janan, just on fuel prices again. So, like you said, bunker fuel prices were already rising coming into this. To what extent is this? Can this crisis be seen to have changed those prices already, or is that actually something that's still coming, the price lift from this current crisis?
Um, the honest answer is both, and they've both hit at the worst possible time. From December through to late February, we've already seen prices climb around 16%, and that was being driven by cold weather tightening, near-term supply in oil, and some general crude price rises. And if we're being candid, a low-level risk of an Iran premium was already been quietly priced in.
Mm.
So the foundations were already shaky, and then the war onset added another 8.9% on top of that in a single week. Like I said earlier, a 9% spike after a period of stable flat prices may be manageable, but a 9% spike on top of 3 months of continuous upward movement means that you're now sitting at a price point that nobody was budgeting for at the start of the year, and the direction of travel is still very much up.
Mm. All right, thank you, Janan. Maybe one for you, Vicky. So, lots of challenges for shippers. How should shippers be thinking about the security and the war risks and managing the supply chains? A very open question, but any thoughts about how they should be thinking about these kind of issues?
Yes, very relevant because MSC just announced today that it will impose war risk surcharges effective as of today until further notice. So when carriers impose these war risk surcharges, um, it's important to treat them also not just as a price increase, but also as a significant operational disruption. And this is why it's important for them to clarify and to clearly define certain rules before they accept the higher cost. For instance, things that need to be clearly defined are the trigger date, the exact lanes or the exact port coverage, and also the exact equipment that these rules and higher costs apply to. And then other things that can be negotiated are the operational aspects, for instance, priority loading and reprotection rules, so that for the shipments that you are paying the surcharge. For instance, if your container load is being rolled or air cargo offloaded, what is the reproduction timeline? So that means what's the deadline by which they must secure the space, or what are the rules for the new move and the relocation. So yeah, those are the key things to consider at times like this.
Yeah, it's very interesting. The whole question of responsibility and risk around the cargo in different locations through different transits is a big thing to consider, and I'm sure will be subject of hot debate between many shippers and carriers coming weeks. And like Janan says as well, to what extent was this foreseeable? I suppose would be another key question as well. I'm not sure any of us really would have expected it to escalate quite so quickly, but it was on the cards, wasn't it, for the last few weeks? All right. We'll have another question on capacity then, I think. So Janan, you mentioned that capacity was 18% down immediately, but that's a huge change, obviously. So, what are the short-term consequences of that? I mean, we've seen a lot of disruption, but can you elaborate on what the disruption might mean?
Um, the most immediate and obvious effect is the space crunch. It was 18% globally, but specifically Asia to Middle East uh, and to Europe capacity is down 26%, which is severe. And what we're seeing as a direct result is airlines rerouting and bypassing the traditional Gulf hubs like Dubai, Abu Dhabi, and Doha, and instead operating more direct Asia to Europe flights, which sounds positive but actually adds flight time and fuel costs.
Mm,
And for cargo moving from India to Europe or India to North America, routings are getting extended significantly. Um, the alternative technical stops that airlines are now using, places that weren't designed to handle this kind of volume, are already showing signs of congestion. Um,
mm,
it might be a potential backlog of a week, even in a scenario where the situation starts to settle down soon.
mm. So we're going to be seeing the delays on the air freight side as well. Yeah, so there's an interesting question around there's longer routes and where the new hubs and where some of these other technical stops might be if more cargo is going to be moving through East Africa or using India as a hub, Indian airports as hubs. And obviously, we're seeing huge amounts of freight moving through flight paths through the Caucasus region. So for a relatively narrow lane as well. So all sorts of choke points to think about there. Um, all right, but I think we'll move towards our last question then. And this again, Vicky, is a very broad one, so forgive me. But how, with all the volatility, shippers obviously are quite used to dealing with volatility and disruption and chaos, if you like, over the last few years. But how can shippers manage or adjust to deal with this kind of volatility they're seeing in the market?
Yes, well, some ocean carriers already paused or slowed down contract negotiations. So um, that might be the best advice for shippers as well to pause, especially long-term tenders. And the ocean carriers did that because they need to assess the situation. They need to assess what the impact will be on their operational costs, but also simply to assess what effective capacity they can offer. But yeah, for shippers in general, that would be the best advice to pause any long-term tenders and to favor shorter-term contracts, more flexible contracts. So using even index link contracts to adapt to this volatility. And also, very important thing to do is to strengthen the flexibility of the contract, and this can be done by clearly defining certain clauses and certain rules. For instance, clearly define the fuel surcharge clauses. Are they transparent? Revisit or review force majeure language, price renegotiation timelines. Another very important thing to consider and to review capacity clauses. We know the big disadvantage of using, for instance, the spot market is exactly this, because in times in disruptions like this, there is this availability and acceptance risk. We've heard that lots of carriers have stopped bookings on these lanes, so it's very important to clearly define these capacity clauses. So, what rights do you have to reallocate volumes? And once this happens, just to make sure that there are no penalties and to protect rates for any recovery moves that will be done if cargo is being rolled to the next available sailing or flight.
Mm. Some good advice there, Vicky. So hopefully that'll help some of our shippers out. All right. Well, thank you very much, Janan and Vicky, for all your insights today. It's very challenging period, but really interesting to get your thoughts on how the situation is unfolding, the consequences of it, and what people can do to manage in these times. If you do want to ask any other questions or access any of the data behind the analysis today, then please do get in touch with Ti. I would be very happy to discuss with you further. Otherwise, thank you very much, Vicky and Janan. It's a pleasure as always, and we'll look forward to seeing you all next time. Thank you very much.